How is everybody doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, we're going to talk a little bit about interest rate risk. The OCC just put out one of their semi-annual reports on interest rate risk statistics, and we're going to take a look at that today and see if that tells us anything or what's kind of going on. So, I did an episode just last week where I basically talked about some of the industry ratios that are affecting banks right now and how do those industry ratios look. They look pretty good, not too bad. But we talked a little bit about interest rate risk toward the end of that episode and basically what banks are kind of afraid of, at least in the short term, over the next 6 months as we are now in a declining interest rate environment where the Fed is gradually going to bring rates down here a little bit. Banks are still worried about what's called margin compression in the short term, and that's where basically banks' margins get compressed a little bit because of the effects of interest rates on that. So in other words, you have assets and liabilities. So on the asset side is the loans for the bank. The banks earn interest on those loans. That's basically the bank's revenue that comes into the bank. But on the liability side, they have to pay out interest on deposits. Now, what happens is banks do what are called gap analysis or sensitivity analysis. They could call it, they call it different names, but it's effectively the same thing. But what they try to do is what's called shocks. They try to do shocks, 400 basis points up, 400 basis points down. And they try to see how are those interest rate shocks. If interest rates go down 100, 200, 300, 400 basis points, how is that going to affect our earnings? How's that going to affect the assets and liabilities on the balance sheet? How's that going to affect our margins? They use all this to a lot of times. And so, and banks have a couple of layers of control on this. So they usually at the board level, there's generally a committee on the board level that's going to look at and observe basically interest rate risk. And they're going to consider that. And usually, that committee is going to kind of set the policy limits and stuff like that, which are going to roll down to the ALCO committee. The ALCO committee is basically going to be run by mostly your C-suite executives. It might be run by, your chief credit officer, your chief risk officer, your chief lending officer, or somebody like that is basically going to run that ALCO committee. You could have different people from the bank participating in that. Like if you have some risk people, some credit people, some lenders, some other, just some other people, maybe some people from finance in the bank. I mean, you could definitely have other people participate in the bank. I think it's great if, because the ALCO committee, which is Asset Liability Management Committee, ALCO is a great committee for really understanding what's going on at the bank, really understanding how the bank manages that interest rate risk. And they also get into, discussions of credit risk as well. And then how, and how does the bank navigate that? Like what changes does the bank make to its balance sheet? How does the bank manage the balance sheet in order to keep the earnings going at an even keel level, hopefully keep the earnings going up? And so I think everybody should get a chance to experience that. I love when banks, they'll kind of do a rotation and they'll just bring in a lot of the employees to just kind of give them a chance to sit in and kind of see what it's like and what it's all about, because it is one of the most critical committees that the bank has. And so you have the ALCO committee, which basically they look at, and sometimes the bank will do their own analysis. Sometimes a bank will hire a consulting firm, which will come in and basically give the bank that gap or sensitivity analysis. And they'll come in and then ALCO will review that and basically say, okay, is everything still within the policy limits that were given to us by the board, by the senior management team and the board? Is everything still within the bounds? And if things go outside the bounds, then they've got to take it back to the senior management team. And then the senior management team might have to take it back to the board and say, hey, we just went outside of policy limits on some of this. And now we're going to have to, kind of move the goalpost a little bit or make some revisions here or maybe change some things that we're doing in order to get everything back into alignment. So that again, and that's a very high level view, a little bit rudimentary, but that's basically the gist of how this works. So let's take a look real quick here. So this is the OCC's website, the Office of the Comptroller of the Currency, and this is the interest rate statistics report. Now, like I said, this is a semi-annual report. They put this report out twice a year, once in the spring, once in the fall. So this is the fall. And then, so let's just read the summary here real quick. So it says, this report presents interest rate risk data gathered during examinations of OCC supervised mid-sized and community banks and federal savings associations, collectively banks. The statistics are for informational purposes only and do not represent OCC suggested limits or exposures. So, and then here is the report itself. Basically, this is the interest rate risk statistics report. And I'm just going to blow this up a little bit, make it a little bit easier for us to see. And as we could come down here, we look at the contents. It basically says about this report, all banks. And then it does break this down by asset size. So we can see, you know, banks with less than 100 million in assets, banks with 100 million to basically 250 million in assets, banks with 250 million to 500 million in assets, and then 500 million to a billion, and then 1 billion to 10 billion, and then banks over 10 billion. So, and it has different charter types, national banks, stock FSAs, mutual FSAs, and then it has minority depository institutions. And then we get a glossary and then technical information on statistical populations and calculations, and then an index of tables at the very end. The glossary is really good. I want to take a minute at the end to kind of look at the glossary, because there's a lot of great terms that I think most people would not be familiar with. And definitely, if you're in banking, you know, if you're a young banker or if you've just gotten into the industry, these are terms that you absolutely are going to need to know. So okay. So about this report. So the Office of the Comptroller of the Currency Semi-Annual Interest Rate Risk Statistics Report presents interest rate risk data gathered during examinations of OCC-supervised mid-sized and community banks, federal savings associations. The OCC supervisory process includes a review of bank-reported IRR data, including exposures, risk limits, and non-maturity deposit assumptions. The OCC compiles these data and breaks them down into statistics for different populations of banks and publishes semi-annually to establish the range of exposures and risk limits across mid-sized and community banks. The statistics are for informational purposes only, and again, do not represent OCC suggested limits or exposures. So this report provides statistics for different bank populations. The OCC calculated exposures and risk limits for the most commonly modeled target accounts in different interest rate stress scenarios. The OCC also calculated key NMD assumptions for different NMD types. This report provides tables with statistics on these different factors. So let's go on. So again, and that's really all the like written information you get on the report is basically page 1. And then the rest of this is just all statistics. So you can see here, you know, table 1, all banks. This is all, it starts out all banks, and then it'll break it down by the different categories. So earnings at risk, you know, 12-month net interest income, parallel shocks. So you can see here. So here's our scenarios: down 200 basis points, down 100 basis points, and then up. We don't really care too much about the up because we're not in an increasing rate environment anymore. We are now in a decreasing rate environment. So we want to see, okay, what is the effect of interest rates going down? So you could see here the scenario: 100, 200 basis point, largest loss, 12%, 25% of revenues. And then you get, you know, 25th percentile, median, 70th percentile. And then we have largest gain over here on the other end of the spectrum. So you could see here that basically, and this is what I was talking about. So in the short term, as rates come down for the next, at least the next 6 months, you're going to see banks are going to continue to see some further margin compression. So which is going to hurt their earnings a little bit for a certain segment of banks. Some banks that, if their balance sheets are positioned really well, might actually have some gains over here as interest rates continue to come down. And then, so you also have this analysis called economic value of equity. And that is another method that banks use, but that is more to determine the stock of value, the book value, if you will, of the bank. You know, what is the equity on the balance sheet of the bank, which leads to ultimately to the tangible book value. And you know, of course, boards love to see that. Executive management teams love to see that because that's their, you know, they're in most cases holding the majority of the stock in the bank. So they want to make sure that, like, hey, I want to make sure the value of the stock, the book value of the bank, the equity of the bank is not dropping through the floor as we get some fluctuation in interest rates here. So so the economic, so the first one's kind of like the sensitivity analysis. How sensitive is your balance sheet to these interest rate shocks? And then the second one is the economic value of equity. So how sensitive is your equity, the overall value of the bank? How is that to these interest rate shocks? And you can see it's kind of the same here. Largest loss at 200, down 200 basis points, 29%. 100 points, 13%. But then over here, you have largest gain on the other side, 82% and 42%. So again, it's kind of a similar thing. So some banks, are going to see a little bit of a hit there in the next 6 months as their margins compress just a little bit. But then at some point, they will start to move out of this. And then we get in here kind of say policy risk limits. Like I said, all the banks have their policy risk limits. For parallel shocks. And you can see here again, kind of the same deal, 25th percentile, 12-month net interest income down 15%, down 10%, median 12-month, again, down 15, down 10, 75th percentile, 10 and 5. So basically, a lot, like I said, a lot of banks are going to see a little bit of hit here in the short term. So, and then all banks, non-maturity deposit assumptions. So money market deposit account, a now interest checking savings account, and then non-interest bearing is not applicable. So, so basically, like, what's the hit are they going to take here? And you can see here at the top, minus 100 basis points, for each of those, and then plus 100 basis points. So we don't really care about the plus. We just want to look at the minus. 100 basis points repricing rates, 25th percentile, 22%, 10%. Repricing rates median, 35, 16, 15%. Repricing rate 75th percentile, 50%, 32, 28. So, so basically the rates on deposits or what banks would classify as the cost of funds, those rates are going to continue to come down, but they may not come down as quick as banks would like because of competition, because of consumer demand. Consumers are, I keep saying this, consumers are liking the interest rates that they're getting right now, and they're not going to want to see those things just, disappear or go away overnight. So, and then now the report begins to basically break it down by asset size. Like, I'm not going to go through every single one of these, but yeah, like I said, so assets, less than 100 million. And then you go 100 million to 250 million. And these are all, and it's all the same scenarios. You have the parallel shocks, and then you have the economic value of equity, and then you have the policy limits, and then you have the non-maturity deposit assumptions. So basically taking in the four key factors, how sensitive is your balance sheet? What about liabilities, your the cost of funds, your policy limits, and then the overall equity value of the bank? How's that looking there? So, and then again, like I said, 100 to 150. But let's go down real quick. I just want to go down to I just want to get down to this okay, so the glossary here. So some of this stuff is really important. So, asset sensitive balance sheet. So banks with assets repricing quicker than liabilities are considered asset sensitive. And asset sensitive banks' earnings generally increase when rates rise and decrease when rates fall. So again, I would argue that most banks out there in the market right now have an asset sensitive balance sheet because the interest rates are going to fall. So the rates on loans are going to fall faster than the rates on liabilities, i.e. the deposits that they have to pay out interest on. So, and then you have like average lives, what's a basis point, charter types, earnings at risk, economic value of equity. Like I said, the EVE models measure the degree to which the economic values of a bank's positions change under different interest rate scenarios. Economic value models focus on a long-term time horizon by capturing future cash flows expected from existing assets, liabilities, and off-balance sheet items. For more information, refer to the interest rate risk booklet. And then you have a definition for interest rate risk, interest rate risk policy limits. These are limits approved by a bank's board of directors and define IRR tolerance over a range of possible interest rate scenarios, just like I said. And then you have a liability sensitive balance sheet. So banks with liabilities repricing quicker than assets are considered liability sensitive. A liability sensitive bank's earnings generally increase when rates fall and decrease when rates rise. So, so again, understanding. And then it gets into a lot of other, like I said, non-maturity deposit assumptions, non-maturity deposit account types, parallel shocks. This type of interest rate stress scenario has two characteristics. The change in interest rates is a parallel shift. In a parallel shift, all points on yield curves in the model are changed by the same amount in the interest rate scenario. In an instantaneous shock scenario, the full change in interest rates as a scenario is implied immediately in the calculation. So in other words, in English, are rates going up or down? And then what type of impact is that ultimately, like I said, having on the assets or liabilities of the balance sheet of the bank? So, and then it has, an appendix here, technical information on statistics, calculations, stuff like that. But like I said, a good report. I really like to look at this. If you, again, if you understand this, you're going to have, if you can understand this, you can get a great understanding of banks and how they operate in terms of the strategy for what they're going to do in the short. And I say the short term, meaning the next 12 months, and the long term, meaning the next, like, say, 2 to 3 years. I mean, most banks, when they have a strategic plan, they have like probably like a 5-year strategic plan to say, okay, what do we want to accomplish? What do we want to do over the next 5 years? But in terms of their projecting and their budgeting, most banks can basically see, about 18 months to 2 years out is what they can see for where the numbers are going to go based on, what's happening in the market, interest rate risk, credit risk, all the other factors and things that are out there and going on. That's why it's so important to constantly look at the industry ratios, because you constantly have to benchmark your bank versus other banks in the industry. How's your bank performing versus your peers? Because that's going to tell you a lot. It's going to tell you a lot. If you can understand these ratios, if you can understand this, the interest rate risk is so key. Like, you can get a real idea as to how banks are going to perform, at least in the next 6 to 12 months. You can look at, like, I can look at this right now and I could basically say, yeah, earnings won't be terrible, but they're not going to be great. And some banks' earnings are going to go down. Like, that's I'd say probably 25 to 30% of banks are probably going to see their earnings decrease over the next 6 months, next quarter or two. But then it'll probably begin to bounce back later on next year, as the interest rates as things kind of settle out, and especially as deposit prices or interest rates paid on deposits really begin to come down, and the bank's margin begins to increase again, as they kind of find that equilibrium, find that balance. So that's how I would expect that to play out. And you can see that by these interest rate numbers that are in this report. So, so like I said, if you have a chance, go take a look at this stuff. It's like I said, it's really key to understand. If you work in the industry, you really have to try to understand these things, because this will give you a great insight as to how a bank works and why banks do things that they do. And again, it can be, it can be tough sometimes, especially like if you've got, people working on the retail side of the bank, and you're trying to explain to them, they might go, well, hey, we're selling, I'm killing it right now. I'm selling all these CDs and I'm doing this and I'm doing that. And then the bank comes in one day and says, hey, we're dropping the CD rates, and maybe we're moving everything to more short term in the way that it's working. In other words, you don't offer a 1-year CD. Now you're just offering a 6-month CD or a 3-month CD with the special premium price. And, and a lot of the retail people go, oh man, now you're killing my, you're making it harder for me to sell and hit my numbers and stuff like that. And they don't really understand, again, why the bank is making that move, and how that, may hurt them for a couple weeks or a month, but ultimately it will kind of work its way out, and things will kind of bounce back to kind of put things back on an even footing at some point. So and like I said, that could be kind of tricky, trying to get people to understand all this stuff, but anyway. So again, I hope everybody liked this. Go check out this report if you get a chance. But I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. Make sure to check out some of the other content on the channel, and I will get back to everybody again real soon. See you later.